If you have ever deposited a large amount of cash, sold a car, received money from your kids, or moved your own savings between banks, there is a specific dollar amount that triggers an automatic federal report. Your bank does not ask your permission. They do not tell you it is happening. The report goes directly to a federal agency most Americans have never heard of. But here is the part that matters most. The report itself is not the problem. What most people do when they find out about this rule, the instinct they follow to protect themselves, is the one decision that can turn their own legal money into a federal criminal investigation. In recent years, the government has seized funds from thousands of Americans whose money was completely legal. I am going to make sure you are never one of them. One honest note before we go further. I am not an attorney, and I am not a tax advisor, and I am not going to pretend to be one. This is educational, not legal advice. Think of it as a plain English explainer and a checklist you take to a professional. With that said, here is how the rule actually works. Under the Bank Secrecy Act of 1970, every financial institution in the United States, every bank, every credit union, every savings and loan, is required by law to file what is called a currency transaction report, a CTR. Anytime a customer makes a cash transaction over $10,000, that report is filed and goes directly to the Financial Crimes Enforcement Network, known as FinCEN. And notice that name. FinCEN is a bureau inside the U.S. Treasury Department. Despite what you may have heard, this is not an IRS rule. The bank files this report, not you. You do not fill out a form. You do not sign anything. You probably will not even know it happened. The bank has 15 days to submit it, and they keep records of it for 5 years. This happens millions of times a year. Millions. And the vast majority of those reports go absolutely nowhere. Nobody calls you. Nobody shows up at your door. Nobody freezes your account. A CTR is not an accusation. It is not an audit. It is not a red flag on your account. It is paperwork. Routine, automatic paperwork. But I need you to hear that clearly, because what I'm about to tell you next is where people get themselves into trouble. When most people hear about the $10,000 rule for the first time, they have the same reaction. They think, well, if 10,000 triggers a report, I will just deposit 9,000. Or, I will break it up. A little here, a little there, spread it across a few days. That decision, that instinct to stay below the line, has a name. It is called structuring, and under federal law, structuring is a crime. Not a fine. Not a warning letter. A federal crime. It is illegal to break up a transaction for the purpose of evading the reporting requirement. You do not need to be laundering money. You do not need to be committing fraud. You do not need to be doing anything wrong with the money itself. If the money is clean, every cent of it legally earned, legally inherited, legally gifted, and you deliberately break it into smaller amounts to stay under the $10,000 line, you've committed a federal offense. And the penalties are severe. As the law stands, for smaller violations in a year, it can mean up to 5 years in federal prison and a $250,000 fine. For larger ones, or ones tied to other illegal activity, up to 10 years and a $500,000 fine. And in both cases, the government can try to seize the money through what is called civil forfeiture. Now, there is an important legal protection here. Back in 1994, the Supreme Court ruled that to convict someone of structuring, the government has to prove 2 things: that you knew about the reporting requirement and that you knew that structuring itself was illegal. That matters. But here is the reality. If you're watching this video, you now know about the rule. So if you go out and break up a deposit to avoid it, a prosecutor will argue you did it on purpose. Do not give them that argument. And this is not a rare, theoretical thing. One government study found that the large majority of structuring forfeitures, around 9 in 10, involved money that was completely legal. Let that sink in. 9 out of 10 people who had their money seized for structuring were not criminals. They were people like you, whose money was clean, who just made the mistake of breaking up their deposits because they thought they were being smart. Now, most people think the $10,000 report is the only thing banks file. It is not. There is a second report called a Suspicious Activity Report, ISAR. And this one is more dangerous because there is no minimum dollar amount. A SAR has no threshold. A bank can file one on a $500 transaction, a $200 transaction. There is no floor. The bank files a SAR when it sees behavior that looks like someone is trying to avoid being reported, and the software they use is sophisticated. It is pattern recognition. It is looking for exactly the kind of behavior people think is clever. 9,000 on Monday, 8,000 on Wednesday, 9,500 the following Monday. The system does not see 3 ordinary deposits. It sees a pattern, and it flags it. And here is what makes a suspicious activity report especially worrying. You will never know one has been filed about you. Federal law prohibits the bank from telling you. It is actually a crime for a bank employee to tell a customer that a SAR has been filed. So you could be flagged right now and have no idea. CTRs are routine. SARs are targeted. And the difference between one and the other often comes down to a single bad decision about how you deposit your own money. So the smartest thing you can do is stop trying to manage what the bank reports and start making sure your paperwork is clean. Because paperwork is your shield. Let me walk you through 5 real situations, the exact moments where people make the wrong call. Scenario 1. Selling a car. You sell your car privately for $14,000. The buyer pays cash. Perfectly legal, perfectly normal. You take the envelope to the bank. What people do wrong is deposit $7,000, wait a few days, and deposit the rest. That is structuring. What to do instead? Deposit the full $14,000 in one transaction. Bring a copy of the bill of sale, the buyer's name, your name, the date, the amount, both signatures. The teller might ask where the money came from. You say, "I sold my car," and you hand them the bill of sale. A report gets filed, nothing happens, and your life goes on. Scenario 2. A gift from your children. Your kids give you $15,000 in cash for a birthday, an anniversary, help with medical bills. The reason does not matter. This is a gift. It is not taxable income to you. But your neighbor told you to deposit $5,000 at 3 different branches, or a friend said cash gifts need to be kept under $10,000. Both are wrong. Both lead to structuring. Here is the truth about gift tax. As of 2025, a person can give up to $19,000 per recipient per year with no reporting at all. And even above that, it is the giver who files a gift tax return, not you. The person receiving a gift does not owe tax on it, so deposit the full amount. Have your child write a 1-paragraph gift letter, their name, your name, the amount, the date, and 1 sentence saying this is a gift with no expectation of repayment. Keep that letter in a folder, and you are done. Scenario 3. Moving your own savings. This is the one that worries me most. You are moving money between your own accounts. Maybe you are consolidating after your spouse passed. Maybe you found a better interest rate. Maybe you are just simplifying. There is a story I heard that has stayed with me. A retired school teacher, 69 years old, recently widowed. While she was grieving, she decided to close one bank account and move the money, $23,000. Her own money, saved over 35 years of teaching. She moved it in small pieces, a few thousand at a time over several weeks. She was not hiding anything. She just did not want to deal with one big transfer while her world was falling apart. 6 weeks later, she got a letter. The bank's software had flagged the pattern. It did not know she had just lost her husband. It did not know she had spent her life teaching children to read. It saw repeated deposits under $10,000, and it filed a suspicious activity report. She was eventually cleared, but the legal fees, the months of anxiety, The stress on top of her grief, none of it needed to happen. If you are moving your own money, transfer the full amount in one transaction. Keep the statements from both accounts. Keep the transfer confirmation. One move, clean records, no pattern to flag. Scenario 4. An inheritance. Your brother passes away and leaves you $40,000 from his estate. The executor writes you a check, or in some cases, hands you cash. For the vast majority of Americans, there is no federal inheritance tax at all. As of 2025, the estate tax exemption is over $13 million. Unless your brother was extraordinarily wealthy, there is no tax on this. But if you receive that money in cash and deposit it in pieces over several weeks, the bank does not see an inheritance, and it does not see grief. It sees structuring. So deposit the full amount, and keep a copy of the will, the estate settlement letter, or the executor's documentation showing where the money came from. That is your proof. File it and forget it. Scenario 5. A Social Security lump sum. This one catches people off guard. If you delayed filing for Social Security, you may receive a retroactive lump sum payment that can easily top $10,000. When that money lands, a report is filed. That is fine. It is routine. But some people panic when they see a large government deposit and start moving money around into smaller amounts. That behavior, even with Social Security money, can trigger a SAR, so leave it alone. Social Security has records of every payment. Your bank has records of the deposit. Everything matches. The documentation exists automatically. Do not create a problem where there's not one. Now, some of you have heard about a proposed $600 reporting rule. This caused a panic a few years ago, and there is still confusion about it. Back in 2021, there was a proposal to lower the reporting threshold for payment apps: Venmo, PayPal, Cash App, Zelle. That was about reporting for digital payment platforms, not bank cash deposits. And that proposal did not become law. So the $10,000 threshold for cash deposits at banks remains exactly where it has been since 1970, unchanged. In fact, as of 2025, there is a proposal going the other direction, to raise the threshold well above $10,000 and adjust it for inflation. It has not passed, but it tells you the conversation is about raising the line, not lowering it. For now, the rule is $10,000, so plan around that. Let us talk about what happens at the bank window, because this is where I see the second big mistake. A teller asks you about a large deposit. This is normal. They are trained to ask. It is part of their job. What to do? Answer briefly and honestly. I sold my car. It is a gift from my daughter. I am consolidating my accounts. One sentence. Hand them whatever documentation you have. That is it. What not to do. Do not volunteer extra information. Do not explain your entire financial life. And do not. I cannot stress this enough. Do not say anything like, I want to avoid being reported, or is this going to trigger something? Those words can end up in a report. And do not offer to break up the deposit. If a teller ever asks, would you like to split this up? The answer is no. Always no. And if you ever receive a letter from a federal agency, if someone from FinCEN or the IRS or the Department of Justice contacts you about your banking, stop. Do not answer questions. Do not sign anything. Do not try to explain yourself. You say 5 words. I would like to contact my attorney. That is your right, and it is the smartest thing you can say in that moment. Find a tax attorney or a criminal defense attorney with experience in financial matters before you say another word. And that brings me to the single most important thing I can tell you today. The report is not the crime. The crime is trying to avoid the report. The $10,000 rule is not a trap. It is not designed to catch retirees. It is a tool the government uses to detect money laundering and financial crime. But the system does not know the difference between someone laundering cash and a retired school teacher who got bad advice from her neighbor. So the rule is simple. Deposit your money, all of it, at once. Keep your records clean. And never ever break up a deposit to stay under a threshold. Before I go, I want to give you something practical, something you can do today in 5 minutes that protects you for the rest of your life. Make a folder, physical or digital, whatever you are comfortable with, and label it Transaction Records. Every time you make a deposit over a few $1,000s, put 4 things in it. 1. A 1-sentence note describing the source, with a date. Received $14,000 from the sale of my car to John Smith on March 5th. 2. The supporting document, the bill of sale, the gift letter, the estate settlement, the Social Security award letter, whatever proves where the money came from. 3. Your bank statement showing the deposit. And 4. Any transfer confirmation if you moved money between accounts. That folder is your entire defense. You will probably never need it. But if you ever do, if someone questions a deposit from 3 years ago, you will be very glad it took you 5 minutes. There is no age exemption from this rule. There is no retirement exemption. There is no, I have been a good citizen my whole life exemption. The law applies to everyone equally. But the people who keep clean records are the ones who sleep well at night. There are too many good, honest people who worked their whole lives and got caught up in a problem they never created simply because no one told them the rules ahead of time. That is what this channel is for. If you know someone who handles large amounts of cash, a parent, a spouse, a neighbor, a friend, send them this video. A few minutes now could save them years of stress later. I am Daniel. This is Money Desk, and we will keep making your money easy to explain and easy to keep. In the next video, we will look at where your money should actually sit once it is safe and explainable, and why a regular checking account may quietly be one of the worst places to leave it. Take care of yourself, and take care of your money. I will see you in the next one, next